Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Standard Chartered plc annual report. Standard Chartered plc offers a wide range of banking products and services across various segments. The company's corporate and investment banking segment provides financial markets products and services, including financing and investment ideas, risk management solutions, foreign exchange, and capital raising solutions. In addition to corporate banking, Standard Chartered also offers retail banking products such as deposits, mortgages, credit cards, and personal loans. Its wealth and retail banking segment caters to individual customers with wealth management products and services like investments, portfolio management, bancassurance, and wealth advice. The company's transaction banking services include cash management, working capital, trade financing, securities and prime services, and payments and liquidity products. It also offers specialized financial solutions such as mergers and acquisitions, leveraged and acquisition finance, infrastructure and development finance, fund finance, and transportation and sustainable finance. Furthermore, Standard Chartered provides international banking, private banking, priority banking, wealth solutions, financing for SMEs, and Islamic banking products to its customers. The company serves a diverse range of clients including financial institutions, governments, banks, investors, corporations, small to medium-sized businesses, and individuals. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The analysis reveals that many companies experienced an increase in net income between 2024 and 2025, with notable examples including a $1.055 billion increase for one company and a $132 million increase for another. However, not all companies saw an increase, as some industries such as corporate banking reported a decrease of 7% in net income. Profit margins also varied across companies and industries, with some experiencing an increase while others saw a decrease. For instance, the operating profit margin increased from 100.2% to 104.1%, but the net interest income margin decreased from 32.5% to 28.7%. Industry-specific changes were also observed, with wealth and retail reporting a significant increase of 24% in net income. The underlying profit before taxation and operating income also saw an increase between 2024 and 2025, rising by $1.089 billion and $1.198 million respectively. Furthermore, the percentage of underlying profit before taxation as a percentage of operating income increased from 34.6% to 37.8%. Overall, these changes suggest that many companies experienced growth in net income and profit margins between 2024 and 2025, with some industries performing better than others. The company's financial performance indicates a significant improvement in its ability to generate cash. One key indicator of this is the net cash from operating activities, which has increased substantially in recent years. In 2025, the company reported a net cash from operating activities of $2,181 million, demonstrating a strong capacity to produce positive operating cash flow. This achievement is a testament to the company's effective management and operational efficiency. The generation of positive operating cash flow allows the company to invest in its business, pay off debts, and return value to shareholders through dividends or share buybacks. Overall, the company's ability to generate significant operating cash flow positions it for continued growth and success. The analysis of the company's debt level and interest expenses reveals a mixed picture. On one hand, total debt has increased from $4,433 million to $4,851 million between 2024 and 2025. However, this increase is largely offset by a significant decrease in subordinated liabilities, which decreased from $10,382 million to $8,834 million over the same period. In terms of interest expenses, there has been a slight decrease in the range of interest rates paid by the company, from 1.77% to 2.01% in 2024 to 1.78% to 1.85% in 2025. However, the actual interest expense has increased from $17,400 million in 2024 to $18,592 million in 2025. The company's total liabilities have also increased significantly, rising from $47.84 billion in 2024 to $102.29 billion in 2025. This increase is largely driven by an increase in senior debt, which decreased from $32.3 billion to $18.1 billion over the same period. Overall, while there are some signs of increased interest expenses and total liabilities, the company's debt level has not changed significantly. The financial documents reveal a mixed performance across various segments and regions. On the positive side, the wealth and retail banking business in Malaysia excelled, driven by strong growth in ultra-high-net-worth clients. The corporate and investment banking business also performed well globally, particularly in key markets such as Singapore, Hong Kong, and the UAE. In addition, the CIB business demonstrated expertise in climate risk management, while the WRB business showed relative strength in physical risk assessment. These successes highlight areas where the company has made significant strides. However, not all segments and regions fared equally well. The corporate and investment banking and wealth and retail banking businesses struggled across various stages, indicating underlying issues that need to be addressed. Furthermore, the AME region, which includes Africa and the Middle East, underperformed, contributing to a loss of $937 million due to restructuring and other items. The debit valuation adjustment, DVA, also had a negative impact on the company's financials. These areas of poor performance will require attention from management to rectify and improve overall results. Standard Chartered's management is emphasizing the importance of sustainability in the company's outlook and strategy. This is evident from their efforts to improve emissions measurement and reporting, as well as their commitment to expanding operations into new markets. The bank also prioritizes risk management, maintaining adequate capital and liquidity levels, and adhering to regulatory requirements. In terms of geographic expansion, Standard Chartered aims to increase its stake in existing markets while entering new ones. This strategic approach is expected to deliver value to shareholders through investments and partnerships. However, the company's cautious approach to disclosures suggests that it may prioritize certain aspects of its reporting over others, potentially indicating a more conservative outlook. Overall, Standard Chartered's management appears to be focused on balancing growth with risk management and sustainability, while also navigating regulatory requirements and market uncertainties. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the most notable ones include the Solve India transaction, which resulted in a gain of $238 million, Mox Bank Limited, SC Ventures, and Computer Software Intangibles, worth $1 million acquired in 2024. The company has also made several divestitures, including the Solve India transaction, FFG, Fit for Growth, Zimbabwe, Angola, Sierra Leone, Aviation Business, Korea, Equity-linked Securities Portfolio. Standard Chartered Research and Technology India Private Limited, SCRTIPL, for $344 million, Africa subsidiaries, venture entities, property, plant and equipment, and Computer Software Intangibles, worth $13 million disposed of in 2025. In terms of financial impact, the acquisitions have resulted in a gain of $238 million from the Solve India transaction. The divestitures have also generated significant proceeds, including $344 million from the sale of SCRTIPL, $74 million from the disposal of Africa subsidiaries, and $23 million from the sale of venture entities. Overall, the company's acquisitions and divestitures have had a significant impact on its financial performance, with both gains and losses resulting from these transactions. The company has a history of rewarding its shareholders through dividend payments and share buybacks. In terms of dividends, the company has consistently paid out to its shareholders over the years, with notable increases in dividend payouts. For instance, in 2025, the company paid an interim dividend of 12.3 cents per ordinary share and a proposed final dividend of 49 cents per ordinary share, resulting in a total dividend payout of 61 cents per ordinary share. In addition to dividend payments, the company has also engaged in significant share buyback programs. In 2025, the company announced a $1.5 billion share buyback program, which was completed on July 30, 2025. Furthermore, the company had previously announced a $2.8 billion share buyback program in 2025. These share buybacks have resulted in a reduction of the number of ordinary shares in issue, benefiting existing shareholders. Overall, the company's commitment to rewarding its shareholders through dividend payments and share buybacks is evident from the data provided. The company has consistently demonstrated its ability to generate cash flows that can be distributed to shareholders, making it an attractive investment opportunity for those seeking regular income and capital appreciation. Concerns about inventory buildup and supply chain disruption are prevalent in the industry. Several factors contribute to these issues, including external trade pressures, U.S. tariffs, and unfavorable base effects. The export growth is expected to decelerate due to fading front-loading activity. Supply chain disruptions are also driven by geopolitical volatility, shifts towards protectionism, and ongoing conflicts. Tariffs and supply chain disruption pose potential uncertainty, particularly around the export of rare earth metals from China. Key material shortages further exacerbate these issues. The reliance on third parties for critical processes is an increasing regulatory focus, and suppliers identified as presenting higher risks of modern slavery are subject to a risk assessment. Sharp falls in world trade volumes and severe worsening of trade tensions also contribute to supply chain disruptions. However, not all pages mention concerns about inventory buildup or supply chain disruption. Some sections highlight the company's efforts to mitigate these risks through sustainability initiatives and emissions reductions. Nevertheless, the overall trend suggests that inventory buildup and supply chain disruption remain significant concerns in the industry. That concludes the financial summary for Standard Chartered plc. Feel free to comment below, and I will be happy to answer them when possible.